Financial Reporting Through the Lens of a Property Casualty Actuary. Chapter 19, Part 5, R3. The RBC Charge for Credit Risk, R3. Credit risk reflects counterparty, the entity owing the insurance company money, credit exposure for receivables, including those relating to reinsurance. It contemplates the risk that the counterparty will default, or not pay in whole or in part, and the risk associated with estimating the amounts recorded for counterparty receivables. R3 is the charge for credit risk associated with the following: 1. Reinsurance recoverable, reinsurance RBC, and 2. Non-invested assets. 3. Health credit risk. The largest component of R3 in the industry is the risk associated with uncollectible reinsurance, due both to reinsurers being unable and unwilling to pay. While there is a charge for health credit risk, it is historically zero for most property casualty companies across the industry. Reinsurance recoverables. The R3 charge for reinsurance recoverables reflects the risk that reinsurers cannot or will not pay amounts the reporting entity expects to receive under the terms of its reinsurance contracts. Over the years, there has been considerable focus in the property casualty industry on reinsurance. For one, uncollectible reinsurance was deemed partly to blame for the failure of Mission Insurance Company and Transit Casualty Company, which helped set RBC in motion for the property casualty industry. Furthermore, throughout the years, reinsurance has been used in certain situations inappropriately to enhance a company's financial position or hide poor financial results. From its inception, the RBC formula applied a simple 10% loading to all eligible reinsurance recoverables. Despite the relatively low impact that R3 has on the industry as a whole, the charge has been subject to criticism from insurance carriers, who have argued that the charge does not differentiate between high and low rated reinsurers, or give credit for those recoverables that are backed by collateral. For 2018, a new formula was introduced to address these concerns. This new formula is performed at the transaction level, and those results are then summed to determine the charge. It applies differentiated risk charges to each reinsurer counterparty based on their credit quality, as indicated by a rating from an approved rating agency, as well as whether or not the recoverables were collateralized. The charge is calculated within columns 28 through 36 of Schedule F, Part 3 of the annual statement. Details of this part of the calculation are described in Chapter 14, covering Schedule F, section titled Credit Risk on Ceded Reinsurance, columns 21 through 36. The RBC formula uses the total row of the results shown in columns 35 and 36 as inputs to the R3 risk charge. Overall, the implementation of this new formula has reduced the level of RBC for reinsurance recoverables by almost a half across the industry. The RBC charge for reinsurance recoverable is split 50-50 between R3 and R4 in circumstances where the reserve RBC charge, see discussion below, exceeds the sum of the credit risk RBC charge for non-invested assets plus 1/2 of the RBC charge for reinsurance recoverables. Otherwise, the full amount of the reinsurance recoverable RBC charge is included in R3. The concept of moving half of the reinsurance recoverable RBC amount to R4 is to recognize there is some dependency between deterioration in reserves and an increase in exposure to reinsurance credit risk. The limitation on splitting the charge based on the size of the reserve RBC charge is put in place so the insurance company cannot diversify away a portion of its credit risk in situations where the company has limited net reserves. Non-invested assets. R3 includes the charge for risk associated with credit exposure resulting from the following non-invested assets listed on the balance sheet. 1. Investment income due and accrued. 2. Guarantee funds receivable or on deposit. 3. Recoverable from parent, subsidiaries, and affiliates. 4. Amounts receivable relating to uninsured accident and health plans. 5. Aggregate write-in for other than invested assets. The RBC charge for these assets is the net admitted value included in column 3 of the asset side of the balance sheet. page 2 of the annual statement, each multiplied by a factor of 0.05, with the exception of investment income due and accrued, which receives a factor of 0.01. The factor for investment income due and accrued is equal to the RBC factor applied to unaffiliated Class II bonds, because most of the investment income due and accrued comes from bonds, which are typically the largest holding for a property casualty insurance company. The receivable assets are generally short-term balances generated in the normal course of doing business. The capital charges for these assets are lower than other long-term recoverables. Health credit risk. Finally, R3 also includes a charge for health credit risk for those reporting entities writing 5% or more in accident and health premiums in any of the last 3 years. This charge considers the risk associated with transferring health risks, morbidity and mortality, to healthcare organizations through fixed prepaid amounts, i.e., capitated payments. There is a risk of non-payment in these situations, similar to traditional reinsurance recoverables. Therefore, a charge is applied to reflect the credit risk associated with the portion of capitated payments over and above the security held by the reporting entity for these organizations. Given that this charge is generally zero for most companies in the property casualty industry, we will not go into details of the calculation of this charge. R3 for fictitious. Table 87 illustrates the calculation of R3 for fictitious.